I want to bring in Tobias Carlisle, who's joining as a portfolio manager of the Acquirers Fund, ticker ZIG. Tom White's going to be doing some trading with us in studio. Tobias, I want to go to your short first, because yesterday I tweeted out that Triple Fat Goose, a competitor to Canada Goose, did a pretty smart marketing campaign. Turns out you're looking at a short on the stock.
Right, and I saw your tweet. I thought it was a great one. I think that Canada Goose is an expensive jacket in an expensive stocks at like 38 times EV/EBITDA, which used to be considered really expensive, 40 times on the PE. The real problem for it, negative free cash flow, negative operating cash flow, negative earnings, debt's been spiking. I think the consumer is a little stretched. It's hard to see going into a downswing in the economy that people buy these premium jackets, particularly when there are alternatives like, as you point out, Triple Fat Goose, or the synthetic alternatives like Save the Duck. I think fair value is around $10. It's trading closer to $38. So it's one that we initiated a short on in late September. So
the thing's already been beaten up quite a bit. It seemed like an earnings report, what was it, 2 earnings ago, was kind of a wake-up call that this company was going to have to move into different avenues for growth. They still are putting up pretty nice numbers, but the interpretation that I had from the market's response to those numbers, Tobias, was that they need to start finding other ways to bring in incremental growth.
Right, and I think they're going to struggle to do that. I think when you tweeted out something this morning, you had a little poll asking which of the jackets people were likely to buy.
Oh yeah, that was Tom's about the brand, right? The button.
It was 100% by a competitor at that time. So I think that maybe some of the lust has come off. I think that in a few years these might look like Crocs for outerwear.
Now, here's the catch, Tobias, which is you've got a season coming up that's good for big furry jackets. The patch, I think, has been one, obviously, that's become like a social statement. Did they not have the power of a Lulu to innovate and try and basically keep that brand power to justify the price? What if they were to look at a price that's slightly lower? I mean, Lulu is obviously expensive too relative to its peers, but Goose is obviously at a very different bracket.
Yeah, does that damage the brand if they do that? I'm not entirely sure that they're able to step down to that lower level, but I think the real problem for them is they're already extremely expensive. So they're sort of at that price point, the stock is, where they have to do something magical each quarter, each year to justify that price. And they can keep on pulling a rabbit out of a hat, but I don't see how they do it. It's priced like a software as a service stock, and it's high fashion.
Yeah. I want to bring in Tom White here, who's with us in studio, Tobias. Hold the thought real quick, because we want to get to your long as well. But Tom, the chart for Goose is already kind of broken. We just saw the lower highs, right, but it hasn't really collapsed yet. So obviously still some value on the short from Toby's point here. How do you see a way to play this in options?
Well, implied volatility is relatively high, but then you have earnings coming up mid next month.
Okay.
But that being said, the pullback that we've seen about 12% so far year to date, and it's been on a downward trend since post-IPO highs above $70 a share. But what I looked at, Oliver, because that implied volatility is a little bit high, and a way to play this, because the stock's up over 3% today, gives you a chance to use options to create a neutral to bearish position. And what I looked at was just in the November 1st weekly series, I went out to the 40 strike, sold that, bought the 42 strike, because I want to stay risk defined, because this is a type of stock, because there's a small float in the open market as far as share count goes, that any upgrade could send this stock relatively higher. So instead of selling a naked call, sold a call vertical. You're collecting roughly about 55 cents on that, probably more than that now because the stock's up higher. But you get that break even about 40, 55 to the upside, which is about 4% higher. So that's a way to take advantage of higher implied volatility with giving yourself a little bit of cushion to the upside, so continue to move higher, but still
you don't need to have this thing collapse, just as long as it doesn't rally, basically.
Yeah, but stay in risk defined in case you do get an upgrade, because that could easily send the stock to 45 bucks.
So to bring back in Tobias, I know that obviously within your fund you go short and long. Tobias, can you give me an idea kind of how you're approaching the trading aspect for getting that exposure to Goose?
Yeah, we're short the equity. We review the position on a regular basis, and we keep them very small. So we trim them if they move against us. We're not able to use options in the ETF, so we tend to be in the more liquid side in the equity.
Okay, so on around earnings, is this going to be sort of the next tell for them? Is this one of these companies that you picture having sort of big gaps if the information is not living up to expectations? Is there a price target where you get out?
Yeah, well, we review it on a rolling basis. I think the thing that really tells for these shorts is whether they're up or down for the year. So at the moment, it has been weak for the last 12 months. I think it's off about 20% over the last 12 months. So it's something that if it rallies strongly, we potentially get out.
All right. Well, the patches, I still see them everywhere, but hey, at a certain point, if everybody's got it, it can't be that cool. Tobias, let's talk your long. I want to go to energy, ConocoPhillips. What needs to happen here? Because as we've discussed for crude, the commodity, this thing just can't seem to hold a bid in.
Right. We discussed this very briefly last time I was on, and the various things that I like about it, it's got $40 to $30 oil, averaging about 35 in an environment where oil's trading between 50 and 55. So I think that where this is hurting a lot of the other oil producers, ConocoPhillips is not doing too badly. They've been generating free cash flow, operating cash flow. They've been paying down debt, and they've recently announced that very significant increase to the dividend, around 38%, plus a $3 billion buyback. I think those are all pretty strong signals that it's a healthy balance sheet. It's still doing pretty well in a tough environment. And if anything happens to the oil price, if it gets a little bit higher, then this is going to be a much more interesting stock.
Okay, so you're basically saying that their break even is still has a buffer zone between the price of oil. Is that what you're talking about, Tobias? Is that sort of the way they can profit?
Right. They got conventional, unconventional oil domestically at $40. Internationally, it's still they can get as low as $30. Averages around $35 with oil at between 50 and 55. They're still making a margin there, where there's some more unconventional, tighter oil around. I think that the real tell, though, is that announcement of that buyback, increasing the dividend, and the fact that they've paid down a great deal of debt over the last few years.
Right. They also increased the guidance that they gave in terms of some of the expenses, but at the same time, the last time they reported earnings, it came in a little bit below estimates for their production. But is the point here, Tobias, that you've got potential? I mean, let me ask it this way, actually. What about the macro side to it? I mean, do you need to have increasing numbers, better outlook for the economy for a ConocoPhillips to perform, or any energy stock?
I think that's probably going to be the catalyst to make something happen, but I don't mind it where it is, because they are already doing all of the things that you would like a company to do. They're paying down that debt, buying back the stock, and increasing the dividend. That's signaling to me that they've got an enormous amount of genuine free cash flow there that they're using in a sensible way with a depressed stock price. So, if you get any bump to the upside, this is something that really does run pretty hard.
All right. Well, they're spending $6 billion in 2018 is the final number that they gave us at the end of that year. So we'll see where they come in 2019, but I believe it's going to be a little higher. Tobias Carlisle, really good stuff. We're going to trade Conoco here. Appreciate it, as always, the insight on the fundamental perspective. Also, upgrades on Conoco today. So it's actually up 1.5%.
Right. Yeah, and you're seeing that. And to his point, I think it was Goldman Sachs that came out with the positive commentary, raise their price target slightly on this name. It's been underperforming, Oliver. It's down about 8%, 9% year to date. Oil's ticked up the last couple sessions. We saw some of the geopolitical risks taking place over in the Mideast, which is putting a bid back into oil.
Okay.
Also, you're seeing a falling dollar help support those commodities. But what I looked at as far as the options trades go, because I like to use options, say mostly risk defined, but what I looked at was going out to November. Now, they have earnings coming up. So I want to kind of play that earnings event where we're going to probably get a positive surprise if you are neutral to bullish on a name like Conoco. And what I looked at was buying one of the 57.5 calls in the November cycle. So you have about 36 days until expiration on that one. And buying one of those and selling two of the 62.5 calls. So it's a 1x2 call spread with a bullish tint to it. You're paying roughly about 90-cent debit for this 1x2. Now, you do have a lot of risk above like 66.60 is the break even on the far upside. But what you do capture, instead of just buying a call vertical, you buy 1x2, you lower the initial price point on that. you're only risking about 90-cent debit on that, so $90 per spread. Your break even on the downside, so you need it to go above 58.40 the upside, but you're going to get a nice return on that 90-cent debit if you reach that apex, which is at the short strike, so you sold 2 of them. So a little unconventional, but you're still taking advantage of an upward move at a lower price point than just buying the risk-defined call vertical instead. Volatility is relatively low in here, even though the stocks pull back. But you really got to watch it if we get a real big pop out of here, which we haven't seen from some of the oil companies in a while. Above 66.5 roughly, you start getting pain.
All right, so the other one, you're selling the calls. This one, you're just basically getting that outright upside exposure.
Exactly.
Yeah, but since you're selling the 62.5s, you've also got a little bit of buffer too in this trade.
Exactly, all the way up to 66.60 is the break even on the upside. So that's roughly about $6-7 to the upside, or $8 to the upside.
All right, nice. We got to run. Thanks to Tobias Carlisle, manager of the Acquirers Fund, ZIG. Thanks to Tom White.